Hi, folks. This is Mike Zlatnik. And today's discussion is going to focus on not just surviving the downturn, but learning how to thrive. It's a very important topic as a lot of stormy weather is on the horizon. Some folks are concerned, and rightfully so, what's coming up. But before we do that, for this conversation, disclaimer, as always, this is for informational, educational purposes. No advice is given. Nothing is being offered. No solicitation at all. For making any investment decisions, consult with your attorney and CPA professional. Now, let's talk a little bit about what's happening out there today. So we've seen, recording this in early to mid-May 2023. So banking crisis, a lot of small regional banks losing deposits. They're tightening up their credit requirements. They're calling the lines. Liquidity is beginning to dry up. Many investors have experienced already challenging investments. Some checks that they've written, some deals beginning to malfunction. Some of them are going bad. Some of them are underperforming. So there are substantial concerns, of course, that the downturn will accelerate some of these problem situations, and these concerns could very well be justified. But I wanted to keep, the purpose of this video is not to scare people or make people more nervous about what's to come. The Fed's action was too fast, too furious. It has drastically destabilized the economy. And the mission to fight inflation is understood. That's their mission. The problem is the implications of what's happening, of what they have done in such short period of time, are very serious. And the economy is not yet collapsing, but we're seeing substantial cracks in the ice. Some problems are microeconomic, some problems are deal specific. So what do folks do about this? And the messages we're hearing is that they're beginning to feel cuts. Kind of death by 1,000 cuts. You get a cut here, you get a cut there, you get a cut with this deal, you get a cut that deal. And the unfortunate part of all this is not just economic losses, which are obviously could be substantial, but also psychological. So why it's important? Well, because the greatest opportunities will happen during typically a downturn. So surviving a downturn is part of the story. Another part of the story is learning how to thrive. Learning how to thrive simply means being prepared, ready, with available cash or access to cash to be able to take advantage of strong deals when they happen. And some of the very important fundamental things are already here. One key point is that the interest rates are most likely at the very peak. They either have peaked already or are about to peak on the short end of the yield curve, meaning that Fed funds rate, short duration maturities, it looks like the Fed is almost done raising interest rates. If they do another small raise, that looks to be absolute the end of the tightening cycle. So that's that. On the long end of the curve, meaning that 10-year Treasury rates have begun to come down already. And the important part of that is that as interest rates slide down, it becomes supportive for the economy. It becomes a positive news. Not only that, the opportunity to refi becomes available, and the pressure from high interest rates will subside over time. So we are sort of at the peak of the interest rate cycle. Now, the transaction volume in real estate has come down substantially because the bid and asks widened and the sellers are not capitulating yet. The buyers are not willing to pay the prices and looking for better deals. So this state of affairs has created essentially a standstill environment where the volume is down 75% from a year ago, approximately, plus minus. So what does it mean? It means that when the opportunities come forward, they usually distressed seller type of situation, and the buyers are coming in and they're getting a great deal. And what's really amazing is that they're getting high interest rates today. So the high interest rates, when you're buying assets with high interest rates on a relative basis, it gives the buyers opportunity to refinance when the rates cycle back down. So if it's a strong buy underwritten today for higher interest rate environment, quite often what I've seen really good sponsors do, they'll underwrite for high interest rates that they can actually obtain today. So for example, they can underwrite that they're getting interest rates at 6.75, while when they close on a deal, they wind up getting interest rate at 6.25 or 6.5. So that conservative underwriting, conservative look at going into the deal with the numbers working at the high interest rates, they'll most likely work even better, or not most likely, it is mathematically substantially likely that the lower interest rates will substantially improve return economics. So the psychological point of this whole discussion is if investors are discouraged from the investing, if the death by 1,000 cuts, or maybe not a death, but injury by a few cuts, will permanently scare them from investing into the deals when the deals are most attractive, when the market has corrected down. That's the concern here. So the message is learn how to thrive by virtue of preparation for participation in these great deals. Obviously, increase access to liquidity, which is not easy to do when the deals are beginning to go bad. Typically, cash is as scarce as it gets. The banks are hurting for deposit, and the investors want to hoard more cash. But that's the opportunity: hoarding more cash, having access to cash. And when you see strong deals, taking a very serious look at them to participate, that may actually magnify the forward return opportunities versus what they were a few years ago. It is unfortunate that investments from the last few years can actually get hurt substantially. It is not a surprise, at this point, it was a peak of the market. The Fed action destabilized the environment and has caused a lot of current issues and more issues to come. The longer the Fed keeps rates at the elevated level, the more pain point there is going to be in the economy. It is by design. The Fed can only fight inflation through demand destruction. That's the only thing they can do. They don't have too many options. So they are doing what they can to fight inflation, but they are causing problems in the economy. And this is by design. This is what they want to do to fight inflation. So the purpose of this message is stay positive, stay strong, look at the opportunities to thrive in an environment that will be painful and difficult. And there will be losses. But if you get discouraged and you stop investing and you basically take the losses at the time when the market is most interesting and most opportunistic, that's maybe that's the wrong timing. It's almost like when everybody's running for the exits, that's the time to come in. And that's what I'm trying to refer. And I think Warren Buffett said, be greedy when others are fearful and be fearful when others are greedy. Simply, the reference is being contrarian and coming in and buying when the prices are low is where the best returns are made, versus the reverse. When everybody's buying, that's the time not to buy for the reasons, or to sell because the market is at the peak. So we've seen, in essence, market, let's call it peak, and then it's correcting right now. And certainly you got to be very careful catching a dropping knife. But there are already good deals happening today where the knife has fell, it's already on the ground, and maybe it's the time to pick it up. So that's the message. Appreciate everyone's time and attention. Again, just be vigilant, be open-minded, and maintain great investor thinking. Learn how to thrive. That's the purpose of the message. Appreciate your time and attention. Until the next time, thank you kindly.